Big shout out to Prime XBT for sponsoring today's video. If you don't know who Prime are a platform where you can not only trade crypto, but you can also trade FX, commodities, and stock indices. And the beauty of these guys is you can use crypto, either Bitcoin or USDT, as collateral to trade against these pairs. If you want to find out more about them, then check out the links down in the description. And if you do want to trade with them, then use our codes below to get up to a 7,000 USDT deposit bonus and 25% off trading fees. So thanks once again for sponsoring today's video. Good morning, gang. Good afternoon, good evening, or good night, depending on what time you're watching this. Welcome back to our third installment of our trading tips for beginners. First and foremost, let me just clarify that nothing discussed today is financial advice. I'm not a financial advisor. This is just for educational purposes only. Now that's out of the way, I want to talk about a topic that's quite common, and lately it's been blowing up on YouTube and Twitter. So I just want to give you my view of it, and that topic is pattern trading. And personally, why I think it's not always the best way to trade. Now, I'm not saying it can't be, because it can be, but you need to understand how to trade patterns properly. And that's something that the cheat sheets that you find out there don't teach you. Now, the cheat sheets I'm referring to are cheat sheets like this. So obviously we can see we've got, reversal patterns, double top, we've got the classic head and shoulders, the wedges, falling wedge, pennants, bull flags, triangles, yada, 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 yada. And as you can see, each one of these are based on trading the breakout. Now, I've covered this time and time again on my channel, why breakout trading is not a great idea. Because most of the time, when you see a breakout of a pattern or of a range, it's just a liquidity grab. So what do I mean by that? Well, let's come back to this, and let's say that you've got a nice sideways range like this, and then we've got price action, and we've got a nice clear range going on like this. And then what we see is something like this. So we see sideways range, we've got clear resistance above, we've got clear support below. And as price comes up to the top of the range, or this can be a pattern as well, whatever you want to call it, what breakout traders do is they come on here, and this is where they're long. And the stop loss, they'll either go for the swing low, or they'll just go just below the breakout, and they're targeting whatever made up target they're looking for. Now what happens more often than not is when price breaks above a level and all these breakout traders come in, which are what I consider the inexperienced traders, is that's just fuel filling up larger traders' short positions. Obviously the opposite, when price breaks to the downside, larger traders are sat there with long limit orders, and people that are trading the breakout are just shorting into a bigger player's limit buys. Up here, people are longing into a bigger player's limit shorts. They then fill their short position, and then price starts to move against them. So this is why breakout trading is not great. And people will argue saying, well, it's a breakout and it's on bullish volume because the volume bar down at the bottom of the screen is a big candle. It's a big green candle, so it's bullish volume. Well, what that doesn't show you is what's happening within that candle. And that's why we need to use things like order flow to be able to see what's going on in said candle. Because the only reason why it ends up being a green candle is because the candle closed green. That doesn't mean it's bullish volume. That just means there's a lot of trades within that candle itself. Okay? So it doesn't necessarily mean strength and that it's going to break off. So you'll get some influencers that'll say, wait for confirmation. So wait for a close outside. Wait for bullish confirmation on volume. And then that's when you long the breakout and you go into the moon. But really, that's not a confirmation at all. Because all that's suggesting is there's a lot of volume coming in here, which likely is all the breakout traders trying to push price further. Then they fail, and we see on CVD, for example, we see some bearish absorption, and then price comes back down. Okay, so this is why I don't like pattern trading. Now, pattern trading can work, as I say. I'm not bashing it, I'm not against it, but the reason why people flock to pattern trading is because it looks simple. People see these patterns on a chart, on a little cheat sheet, and they think it's easy. Just like when people first start trading, and you know, if you look at some of the teenagers on TikTok and the teenagers on YouTube, and they're teaching you how to use MACD, crossover strategies, or RSI divergence strategies, or, you know, a lot of these indicators as well, which again, they're not great. It just makes trading look easy. Now, the reality is, if trading was that easy, then everyone in the world would be rich. But the reality is, it's complete opposite. There's a small handful of people that make money out of it, and the rest of people are just liquidity, and they lose money. Okay? So, what I want to do today is just run through a few patterns. And these are patterns that I've picked out, and I've picked these out from Twitter, from some of the moon boys, that are what I called influencers. And these are what get people wrecked, really. So I want to show you this, and I want to show you why it traps people. So let's zoom in. So I've got a handful, and I've got some working and I've got some non-working. So I'm giving both sides of the argument here. So first and foremost, let's have a look. So this is going back to 2021, and I remember this well. So what I'm going to do first is I'm going to hide this. I'm going to show you this triangle. So we've got a triangle going on. So we've got we've got a downward sloping trend line. We've got a flat base. So according to a pattern cheat sheet, this is a descending triangle, and what they will teach you is a descending triangle is more likely to break to the downside. Okay, so therefore what happens is every time price breaks through one of these levels, people FOMO short because they're trying to trade the breakout. So it comes down here, place the short position, whatever the stop loss may be, and then the targeting a measured move, which would be from this point to this point, and this is what they're targeting. Okay, and as we can see, on the first attempt here, price comes down, wicks down, comes back up, stopped you out. You know, or it might not have stopped you out, it might have been, you know, a little bit more sensible and had a wider stop loss. But either way, your trade didn't play out. So what happens? Well, the same thing happens again. Another short. So you long the breakout, and again, you just exit liquidity for someone else. Same measured move from the triangle target, gets nowhere near your target, you trade the breakout and instantly stopped out. And that's if you're using a stop loss. That's if you've got enough brain cells to actually use one. Okay? So let's have a look on this as well on the volume. So let's throw on volume here. Let's just hide this. And we can see here, we've got high volume in this candle here. And then the volume is just up and down throughout. Now what you want to see in a triangle is you want to see volume dying off as it goes along. So that would show you more realistically if it is a triangle. But this volume isn't dying off. It's, you know, we're spiking. You know, there's no downward slope of the volume. There's only one way to trade it. The actual best way to trade a triangle is understanding Elliott wave theory. Okay? And that's something that we teach on our website. So if you guys want to check that out, then go to our website, which is spitfiretraders.com. Okay? So, two breakout shorts. Both got screwed. In the end, it breaks out to the upside. Okay? But realistically, rather than trying to force fit a pattern on here to make things look easy like influencers make you do, is we just throw on a sideways channel. This way, we can see we've got daily resistance up here. These are daily candles. We've got daily resistance up here, which price is failing to break out. Okay? So in this, you've got a perfect short trade to the lows. Okay? You've got a long trade towards the highs, albeit it didn't get there. Then you come back down to the lows. So if you're trading this range, you're longing the bottom and you're shorting the top. Okay? Rather than shorting a breakout, two fails, you're long in the lows, you're short in the highs. You're long in the lows, short in the highs, and eventually you get stopped out. Okay? So you take one loss when you're trading the range. But when you're trading the triangle, you're taking two losses. And you're not taking any winners apart from this one. Okay? So your hit rate's not great. So the actual technical breakout of this consolidation is here. It's not here, it's here. Okay? So, again, triangles, you know, it's descending, but that doesn't necessarily mean it's going to break down. Okay? And again, if you understand Elliott wave theory, you understand this a little bit better. and you've got more of a realistic overview of which way it's going to break. Now next, we've talked about this before, because we've talked about this as the 3 drive patterns in the last video, about how to spot market tops, and the old 3 drives pattern is great. Didn't draw that right. Let's draw it right this second time without the double clicks bit. Here we go. 3 drives. Okay, so we've got a 3 drives pattern, but in more simple terms, we've got a rising wedge. Now a rising wedge, in my eyes, is a valid pattern, but it's only a valid pattern if you understand Elliott wave theory. Okay, so a rising wedge statistically is more likely to break down, but that's only based on context. Now we can see here in this, we've got a rising wedge and we can see volumes drying off. We're also seeing some significant divergences, like we pointed out last week, significant divergences of 3 drives variety, in fact 4 drives in the end. So we can see all this going on. Okay, so let's hide this again. So in this, rather than trying to trade the breakout, which in the end did work for you if you did, but you might have shorted the breakout, targeting the bottom of the wedge, but then you may have been stopped out here because price comes back up and it tests back where the breakout happened. Okay, and then it followed through. Now the target of a rising wedge, as people will lead you to believe, is the start of the wedge, but this actually went a lot further. And again, if you watch last week's video, last Sunday's video, you'll see why I shorted this, and it was based on the wedge / the 3 drives pattern. Okay, and your safer short from this was this area. Why? Because it was the golden pocket at the time. Okay, so this is an example of a pattern actually working. But what you can also find is this is what I would consider an ending diagonal. This is in Elliott wave terms. Okay, but you can also have a leading diagonal. Now what does this mean? Well, this is the start of a pattern. So what you'll find is you'll get price moving up into it, then you'll see a small fake out, and then you'll see price continue up. And this is a great example of when people will short the breakdown, just like here, they'll short the breakout, and then what happens, price will reverse them, because this is what you call a leading diagonal, and this comes down to Elliott wave theory. So if you understand Elliott wave theory, you have a way better time of trading patterns. Okay, because all these patterns tie into Elliott wave theory, but it's all about understanding context. Okay, this, lots of bearish divergence, context, bearish. Okay, this, in this example, no bearish divergence, price pushes up. Okay, now divergence isn't the only way to figure it out, but as I say, if you understand Elliott wave theory, you get a better idea. Next, this is a classic, the old head and shoulders pattern. Let's come up here. Head and shoulders. So this is one I remember. This is at the time. Obviously, this is coming back up to the 69k top. And I remember people posting this all over Twitter saying, inverse head and shoulders, we're going to 100k. Okay. Now, the measured target on head and shoulders would be the top of the head to the neckline, and then project it from the breakout. Okay. So what did people do here? Well, as you expect, people longed the breakout, targeting this move up here. Okay, what happened in the end? Well, it didn't get anywhere near the measured move, and it reversed. Okay, and why wasn't this a valid head and shoulders pattern? Well, first, your volume is all off. Volume is completely off. And second, it's not a continuation pattern. A head and shoulders is a reversal pattern. So if you were going to spot head and shoulders up here, ideally you'd be looking at it the other way around, and you'd want to see something like this way, because we're at the top of a large move, and then you'd be looking for a reversal. Okay, and then you want the volume to match along with this. Once again, I wouldn't personally be shorting the breakout. I'd be looking for a short position up here, looking for other technical confluence at this level. So once again, people longing this, looking for that 100k made up target, and never reaches the target. All this is liquidity and price reverses. Okay, so when you're trading patterns alone without any context and without any other form of TA, this is where you go wrong. Okay, next one. The old W bottom, double bottom, Adam and Eve, whatever you want to call it. Again, this is another pattern that I personally can't stand because this is just shilled by influencers that haven't got a clue how to trade. So, first drop down to 32k after the 69k high. We came down, we came back up, and some people were screaming this as a W or a double bottom, and then that's it. Again, the measured move of this would be taking the neckline, taking the height of this, portraying it onto that, which will give us the target up here. Now, again, people just looking at this, they've got no other context. No other context. What's going on? What else have we got on this chart that could show us that we've actually got significant resistance here? Well, like if you guys watch our videos, then you will see that we're a massive fan of volume profiles. Okay? Or, if you're an order block trader, this whole block is such. Okay? So all it's done is come into a supply zone. All these long breakouts, all these breakout traders are getting absorbed now by larger players that are filling their short positions, ready to break it down. So when this breaks, you can see here it breaks and it moves. And we can even see on volume, we even get a spike of volume around when it's happening. Okay? So influencers will lead you to believe now that this is a successful breakout. Long it, go for the target. But reality, it just rolls over, it gets nowhere near the target. Okay? Because they're not taking into account what else is on the chart. All they're looking at is a pattern. Again, it's luring you in to think that trading is dead simple, which is why people like these patterns. But it's not that simple. If it was, again, we'd all be rich. Okay? But the reality is, not everyone is rich. Most people lose, and this is why. Okay? So that's that example. Next we come down here. This is again another one, and I pointed this out on one of my Bitcoin videos at the time. So let's just hide this for the time being. You can see here, we've got a triangle. We've got a triangle. So price comes down, bounce, another tap of the high, we've got a downward sloping high, and then we've got the low. Okay, now you could say however you want to draw it, matching it up as much as possible. Now what people are doing is trading this and breakout, trading the breakouts, and price just comes back in, stops you out before ultimately going in the direction of what you wanted it to in the first place. But again, they've got no other context what's going on here, which is why we throw on something like a fixed range volume profile. So we can see here that every time price tries to come up, all we're doing is we're rejecting off this value area high. Okay? This is a slight front run, admittedly. But we're just rejecting because we're in a high volume area up here. This is the outskirts of value. Right? Same with the lows. If you were trading this breakout, then you're just shorting into the value area low, which has been currently holding price up. And we can see even people that were trading these breakouts, trading breakouts, price reverses. Okay? There's actually a short video on our YouTube if you want to find that, where it actually shows what was happening at each one of these lows and each one of these highs. Because ultimately, all it was a sideways range. There's no need to throw patterns onto a very simple, straightforward sideways range. All you need is two horizontal lines. You don't need to start adding patterns on. There's no context. Now in the end, it did go in the right direction, but this is messy as hell. And people would have been longing each one of these wicks up, longing the breakout and just getting trapped. Okay? So you need to understand the context, understand the bigger picture. Right. And then that leads us finally to this one. The old bull flag. Now, yes, if you look on some of these pattern cheat sheets, yes, you know, some of them do show this upward sloping flag, admittedly. But for me, once again, I'm never going to trade this as a pattern. Because if you trade this as a pattern, then your technical target would be from the start of the move, which is down here, this wick here, you start off the move, up to this, and then you're going to throw this on top. So we're looking up at 26k. Now, could price get there? Of course it could. Of course it could. But what is the resistance up here? And why is it that every time someone longs one of these little breakout wicks, they're getting wrecked? Well, quite simply because we're in high time frame resistance. What do I mean by that? Well, if we throw a Fibonacci from the 25k high of the range to the current lows at 15.5, we'll throw this here and we're up against a macro golden pocket. This is a high time frame golden pocket. Zooming out to the daily, look, macro golden pocket. So do you really think trying to long this breakout into significant resistance is the most sensible trade? And we've seen it. If you watched this week's Bitcoin update on Thursday, we can see all we did on each one of these wicks, regardless of the pattern, each one of these wicks, we just did a simple swing failure pattern. One wick. Next week. Next week. This week, swing failure pattern. In fact, this wick here is a swing failure pattern of the original wick, depending on the exchange that you're on. So we've got a swing failure pattern of this. We've then got a swing failure pattern of this. Swing failure pattern of this. Swing failure pattern of this. Every single time, we just trapped breakout traders and reversed. Okay? So rather than trying to get involved in this pattern and ignoring everything else on your chart, look for the most simple idea. Well, what's the most simple idea? Well, quite clearly, we've got a range. Okay, let's hide other things. Let's get rid of this bullshit pattern, and we've got a range. Okay, now admittedly, this is on Bitstamp, and it's not as clear as some of the other exchanges, but we've got a nice range. We've got an EQ, we've got a range high, and then we've got the deviations. We've got a range low, and then we've got the deviations. We've got a nice sideways range to trade. So rather than trying to long every single breakout of this potential bull flag into significant high time frame resistance, you could just be quite easily longing the lows, shorting the highs. Then you had another valid short, then you had another valid short, then you had another valid short. Admittedly, the last one was the best one because it actually came back down to the range lows. Okay, then you had a valid long. And then the beauty of this is you're holding a long from the low, you're holding a short from the high. You've taken profits at sensible locations because you're not a fool. Then you move your stops to entry, and then you don't care if it breaks that way or it breaks that way. If it breaks down, you're still holding this short and you've still got some profits left in it to take at the next logical support region. If you're holding these longs still, and you've taken some profits at sensible levels, and it does break to the upside, then you've still got some money left in the trade to take profits higher at the next major resistance. So stop trading these and trade this. Okay? Now if you guys want to know how I trade these patterns properly and in detail, then come over to our website, links down in the description, spitfiretraders.com. First and foremost, join our free Discord, where you'll get access to a lot of hints and tips, including a few tips on pattern trading. And then move over to our Copilots course. And within this, you can see here, we've got learning modules. You know, you're learning from professional traders like myself that's been doing this for God knows how many years now. Weekly live streams, cheat sheets, tools. You know, you'll be surrounded by other like-minded individuals, which is always a good thing because you need that encouragement. And I say, 60 quid. Well, it's less than 60 quid a month. And within that, you will see, if I pull over this tab here, we have a whole range of pattern modules. Pattern module 1, 2, 3, 4, and 5. Now, each one of these, I explain how to trade these patterns that we were talking about before, but how to trade them well. And in more cases than not, it's how to counter trade them. Looking for those breakout traders and counter trading them. Going against them. So going against the majority that are going to lose money. Okay? So if you guys are interested in that, head over to our website and come check out our Copilots course. Okay? That'll do for this week's video. Hopefully you've learned something. If you have, smash that like. Let me know down in the comments. And don't forget to subscribe. Alright, gang, as you were. Bye bye.